Hey there, I am Mindy Strong, and today I'm going to talk to you guys a little bit about U.S. government debt. We are studying for the Series 65, and I'm in the second section, investment vehicles, and today I'm going to cover U.S. government debt for you. This should be a supplemental way of studying for any online program you have, not instead of. All right, here we go. First of all, U.S. government debt is the largest and most active trading in the world. The Federal Reserve has oversight. Long-term bonds, intermediate-term notes, and short-term Treasury bills are all included in that. And all of these are issued in book entry form. Okay, so first of all, we have Treasury Bonds. They take 30 years to mature. They're issued in $100 minimums. They pay interest semi-annually, and these are non-callable. Non-callable. Second, we have our strips, and they are stripped of the coupons. That means they are stripped of the semi-annual interest payments. They're also called zero coupon obligations or zero coupon bonds. These only make sense if they are kept in retirement, in tax-deferred retirement plans. The reason being, you will be taxed on those semi-annual interest payments that you would be getting, even though you actually won't, because these are issued at a discount and mature at par. So you certainly don't want to be taxed on money you haven't gotten yet. Therefore, these are great as long as they are held in a tax-deferred plan. They're also known as zero coupon bonds or treasury receipts. So they are subject to federal income tax, as I just talked about. There's no reinvestment risk. So because they're issued at a discount and mature at par, instead of having to worry about getting those semi-annual interest payments and reinvesting those, and what if the interest rates go down or up and you're reinvesting them and you're losing money on your investment? You don't have to worry about that with these because they're issued at a discount and mature at par. These are issued by broker dealers. However, you do have interest rate risk. When you get a zero coupon bond, you are locking in an interest rate. And then what happens if interest rates go up? That's not good, right? And these are held by a trustee. So they're very safe investments. And again, we would find these in tax-deferred retirement plans. Then there's something called TIPS, which are Treasury Inflation Protection Securities. So we know that inflation means that the cost of goods is rising, right? The cost to us is rising. So these TIPS are issued with a fixed interest rate, but the principal is adjusted every 6 months. So the interest rate is paid semi-annually, and then the interest rate payment is adjusted based on inflation. So this allows you to protect yourself against purchasing power risk. However, because these are safer, and we have learned this concept throughout, if we have something that's less risky, that's safer, we understand that it's going to have a lower interest rate payment than others. But also, this is because of that inflation protection. These are only available for long-term treasury issues. TIPS. Okay, then we have Treasury Notes. Those are the intermediate term securities, 1 to 10 years. Again, we got a minimum of $100. They pay interest semi-annually, and they are also non-callable and quoted in 1/32. Then we have Treasury Bills. These are our shortest term securities, up to a year, minimum of $100. They're issued at a discount and they mature at par. And these are the least volatile if the interest rates rise. Makes sense? Okay. They are subject to federal tax, but they're exempt from state and local tax because one level of government cannot tax another. Makes sense. Okay. Yes, federal tax, no in state and local. Then we have U.S. government agency obligations. One main one that you're going to learn about is the Federal Farm Credit System. And these have different variations. One is You can get a discount note. It's 1 year or less. It is sold at a discount. Then we have designated bonds. Those are traditional, non-callable, semi-annual payments, and they're 2 to 10 years. And then we have the bonds that we know and love. We've got the traditional callable bonds, which are also issue semi-annual payments, and you can get them up to 30 years, and you can get fixed or floating rates. Then we have retail bonds. So this is a bond that has a survivor's option, so it can be paid out upon death. Now, it's very important that you know different farmers' agencies. You've got the federal land banks, federal intermediate credit banks, and banks for cooperatives. Then we have the secondary market home mortgages. So we've got the federal home loan banks. We have Federal National Mortgage Association, also known as Fannie Mae. Government National Mortgage Association, known as Ginnie Mae. That is the government-backed one. The way I remember this is Ginnie starts with a G, government starts with a G. Pretty simple for me. Haha. Federal Home Loan Mortgage Corporation is also known as Freddie Mac. And Freddie Mac only deals in conventional loans, and we're going to talk about that more in a second. But the only male here is Freddie, and he's more conventional. That's how I remember that. Okay, Federal Home Loan Banks, so you can get discount notes, short-term obligations, 1 year or less. Then there's the callable, non-callable bonds, which are up to 30 years with semi-annual payments. And then you have Fannie, Freddie, and Ginnie, which are your mortgage-backed pass-through certificates. Mortgage-backed pass-through certificates are going to work a little differently. There is a $25,000 minimum, and the payments are monthly. Think of mortgage payments. The payments are monthly. So here we're going to look a little more in depth. Fannie Mae buys the VA, FHA guaranteed mortgages and conventional mortgages. This is privatized. Ginnie Mae, remember Ginnie starts with G, so does government. These are owned and backed by the federal government. They don't buy conventional mortgages, but they do have FHA, VA, and the Farmers Home Administration. And then we have Freddie Mac. He's conventional, only buys conventional loans. And then we introduce Sallie, good old Sallie Mae. Sallie starts with an S, so does student for student loans, semi-annual interest payments, and this is privatized. Okay, so Freddie is conventional. Ginnie Mae starts with a G, as does government. And then we have Sallie Mae starts with an S, as does student. Pass-through certificates. It's a security which gives the holder an undivided interest in a pool of mortgages. The mortgage payments are passed through to the certificate holders, and that's done on a monthly payment basis. Now, let's look at the tax status of government and agency debt interest. Okay. Government and unprivatized are subject to federal, but they're exempt from state and local. Government and unprivatized are subject to federal, but they're exempt from state and local tax. Interest earned is taxed in the year it's received for short-term Treasury Bills and short-term unprivatized notes. Discount on strips is taxed annually. And remember, if we own strips, we need them to be in a retirement account that is tax deferred. Tips, there's our inflation protection security. It's also taxed on the increase in principal. And then we have our privatized debt, like Freddie Mac, Fannie Mae, that's fully taxable. And Ginnie Mae is also fully taxable. Okay? That's it. That is our U.S. government debt. Pretty simple. There are a lot of questions in here on this screen in particular. Knowing the difference between how each of these can be taxed is important. really understanding zero coupon bonds is important. I hope this helps, but this is your overview for U.S. government debt.